Okay, let me let everyone in. I think we got everyone. All right. Good afternoon, everyone, and thank you all for joining us for today's a month of service presentation of foreclosures. We're talking about mortgages, home equity loans, and reverse mortgage foreclosures today. My name is Nia Murray. I am the programs coordinator with Neighborhood Recovery Community Development Corporation, and we are one of the partners in the A Month of Service collaboration. Also included is the City of Houston's Department of Neighborhoods, and joining us, we have Ms. Rachel Gutierrez. Also representing our partners with Lone Star Legal Aid, we have Ms. Lauren Masulo Martin and Ms. Samantha Guzman, who's going to be presenting the information for you today about our foreclosure topic. Also included in the partnership, we have the Earl Carl Institute, Texas Legal Services Center, Houston Volunteer Lawyers, Harris Central Appraisal District, Harris County Tax Assessor Collector's Office, as well as the Houston Bar Association. And together we make up a month of service. And basically what a month of service is, it's the collaboration of all 9 of our organizations. We come together on a monthly basis, offering a variety of different workshops, resources, and information to the community relative to asset building, asset protection, the maintaining of generational wealth, and community empowerment. We know that there are a lot of underserved communities that are out there that don't have access to a lot of information and resources. So we decided several years ago to come together in a collective effort to try and reach more people, get more information out to as many people as we can that need the services, especially those legal services that can assist them with again protecting their assets and maintaining their generational wealth. The programs or the workshops that we are offering have expanded or have kind of evolved over the last several years. So if there are currently workshops that you guys may be topics that you may be interested in that we don't currently offer, then please reach out to us and let us know so that we can make an effort to get as much information out there to you guys as we can. Also note that the information that we do present here today is for educational purposes only. It is not to be considered legal advice. However, we do encourage you to reach out to their legal service partners like Lone Star if you do find yourselves in need of any civil legal assistance. In addition to that, also to know that we are broadcasting live on our social media platform on Facebook, as well as recording the session so that we can send it out to everyone that have registered so that they can go back and watch it again, review it for other updates, as well as sharing the information with other people. So we ask that you try to keep your questions to be as general as you possibly can, so that you don't divulge any personal detail information. Because again, we want to try to protect your privacy as much as we possibly can. So, however, we do encourage you to be as interactive as you'd like to be. Feel free to ask questions that you may have related to the topic of our presenters. You can type it into the chat box, or you can raise your hand and unmute yourself at the end of the presentation and ask questions verbally. If you are joining us on Facebook, or if you emailed questions to me ahead of time, then I will be going back and reading those questions aloud so that they can get addressed as well. So with that being said, there's a lot of information that's going to be covered here today. We know that there are a lot of folks that are still experiencing um, uh, financial hardships, especially those due to COVID, from being off work and things like that, a lot of budget cuts that are going on around here. So in case you are experiencing or potentially um, uh, facing foreclosure, we hope that the information that is provided here today for you will be helpful and beneficial to you. So we are going to go ahead and go into our presentations. Um, I believe Rachel is oh, yep, there she goes. All right, Rachel, we'll have you go ahead and introduce yourself first, and Samantha and Lauren will have you guys introduce yourselves afterwards. So Rachel, go right ahead.
Yes, hello everyone. Good afternoon. Sorry, I was taking a phone call. We're, as you all know, we're in disaster recovery mode right now within the city. So it's been a kind of hectic, but good afternoon. I made it. Thank you all for joining us to this afternoon. for this month of service workshop. My name is Rachel Gutierrez. I am a community outreach coordinator for the Department of Neighborhoods, Office of Neighborhood Engagement. On behalf of Mayor Whitmire and our Director Sims, we welcome you to this workshop. We appreciate the partners and their time for volunteering to be able to put on this incredible workshop for you guys for free, which is something that you can hardly say that you can receive somewhere else. So we truly appreciate your participation in this. And we also appreciate your support in spreading the information to those around you, not only for you to inform them, but encourage them to attend these workshops. I'm sure, based on all the information that we have, the different workshops, there is something there that that somebody could benefit from. We all go through different changes at different times, experience different obstacles at different times. So this information is there in order to guide you through those times. So if you do us a favor and continue to spread the word at church, in grocery store, at your community meetings, we will greatly appreciate it. And if there is a topic of that we currently don't have and you would like to see put on, feel free to reach out to myself or to Nia, and we will work to see if we can put that on for you. But again, we do appreciate your participation and engagement. And again, thank you to the partners for being able to put this on for us. So thank you so much.
Okay, Samantha and Lauren.
Hey, everybody. So I'm Samantha Guzman, a paralegal with the Foreclosure Prevention Project here at Lone Star Legal Aid. And I'm joined by...
Hi, I'm Lauren Masila Martin. I'm with Lone Star Legal Aid as well. I'm a staff attorney here with our Foreclosure Prevention Project. And we are both just so grateful to be able to be part of this partnership and to present today to you guys and hope to be helpful.
Okay, go right ahead.
So I'm gonna get started and share my screen. So today we're going to be talking about mortgage foreclosures. I'm sure you've heard us discuss this in the past, but it's a favorite topic of ours, so we're going to do it again. As a reminder, today's presentation provides legal information only and is not legal advice. We cannot tell you what type of mortgage loan or loss mitigation option is best for you. Please consult your financial, tax advisor, and/or lawyer for advice regarding your personal situation. Today's agenda will be as follows. We'll discuss a little about Lone Star Legal Aid. Then we'll go into disaster assistance a little bit, and then we'll give a brief update on the Texas Homeowner Assistance Fund, followed by our mortgage foreclosures generally information. Then we'll move into loss mitigation, and we'll get down to specific mortgages, followed by our Q&A at the end. So here at Lone Star Legal Aid, we protect and advance the civil legal rights of the millions of Texans living in poverty. We do serve 76 counties where we provide free advocacy, legal representation, and community education that ensures equal access to justice. So some fast facts about Lone Star Legal Aid. As I mentioned, we do serve 76 counties, and we'll get into specifics in a few seconds, but our services reach approximately 60,000 square miles, or 1/3 of the state, including 72 counties in the eastern and Gulf Coast regions of Texas and 4 counties in Southwest Arkansas. We have 14 offices in addition to our Houston headquarters. We do have 13 branch offices, and we'll discuss that again. Based on the most recent census data for our service area, there are approximately 1,977,281 people at 125% of the federal poverty guidelines who are eligible for our services. In 2023, Lone Star Legal Aid completed over 23,673 cases, impacting approximately 60,000 individuals, of which 33% were survivors of domestic violence 18.5% were 60 or older, and 7.5% were veterans. A little brief history about Lone Star Legal Aid. So over the years, well, in 1960s, the Houston Legal Foundation offered criminal defense for a period in response to the Supreme Court decision in Gideon v. Wainwright. And the Houston Legal Foundation eventually became known as the Gulf Coast Legal Foundation. In the 1980s, East Texas Legal Services created the East Texas Fair Housing Center to investigate, address, and monitor corrective actions related to violations of the Fair Housing Act. A merger was formed in 2002 where the East Texas Legal Services, a largely rural legal aid program, and the primarily urban Gulf Coast Legal Foundation, along with the portion of legal aid of Central Texas, were combined to become Lone Star Legal Aid as you know it today. We are the third largest legal aid organization of its type in the United States. Lone Star Legal Aid has a proud tradition of successful client-centered work, and historically, the firm has won victories that affect not only the client who initially presented a particular issue, but groups of low-income people on community, state, and national levels. Our firm's actions have resulted in systemic policy and procedural changes like public housing desegregation and healthcare access for children. So who do we help here at Lone Star Legal Aid? We help children, veterans, seniors, the LGBTQIA plus community, people with disabilities, and those who are homeless. The majority of our clients are women, most of whom are mothers. Many of our clients face isolation due to limited literacy, living in rural and remote locations, and language barriers. More than 1.5 million people in our service region speak a language other than English, and we are here to provide assistance for those who don't speak English as well. In Texas, there is one attorney for roughly every 380 people in the general population. However, there is only one legal aid attorney for approximately every 17,000 people in our service area with income at or below 125% of the federal poverty guidelines. We limited access to modern mass communication media, such as telephones, computers, and cable television, is common among our client community, and there is little or no public transportation in most of the rural areas we serve. Again, our mission here at Lone Star Legal Aid is to protect and advance the civil legal rights of the millions of Texans living in poverty by providing free advocacy, legal representation, and community education that ensures equal access to justice. Our eligibility, we do help people living in the 76 counties we serve. We only work on civil cases, and we do not handle criminal cases. We help those who are low income individuals. So some substantive types of law that we practice here at Lone Star Legal Aid are consumer, employment, family law, healthcare, housing, juvenile issues, neighborhood problems, public education, financial assistance, and public benefits. Some special projects we do have here at Lone Star Legal Aid will include civil matters and criminal justice project, community advocacy, consumer law, crime victims unit, disaster relief, employment, environmental justice. We have a low income taxpayer unit, a medical legal partnership, legal assistance to survivors of sexual assault, eviction rights to counsel, a fair housing unit, a military and veterans unit, our foreclosure prevention project, and a justice for older adults project. We also have a rights recovery unit, which helps with this opioid epidemic that we are currently going through in the United States and in Texas. So how do you ask for help from Lone Star Legal Aid? You can apply 24 hours a day, 7 days a week by visiting www.lonestarlegal.org. If you do not have access to the internet, you can give us a call at 1-800-733-8394, Monday through Friday during regular business hours. I do want to pause and note that our Houston offices we're still working from home, but we do catch some people that come to our doors seeking legal assistance. So if you get here before 2 o'clock Monday to Friday, you might catch somebody here if you don't have access to a phone or internet services. So we'll discuss our branch offices now. So we do have an office in Beaumont, Belton, Bryan, Clute, Conroe, which I believe their office has suffered some damage, so they're not quite open to the public yet. Galveston, Houston, Longview, Nacogdoches, Paris, Texarkana, Tyler, Richmond, and Waco. You can find us on social media via our Instagram, and our handle is at LoneStarLegalAid.org. For Facebook, you can find us at Lone Star Legal Aid. For Facebook, it's also Lone Star Legal Aid. And on YouTube, it's L-Star Legal. So let's get into disaster assistance. I know some of us we're all recovering from the storms that hit us last Thursday. And we wanted to provide a short update about how you can find some disaster assistance. So again, you can go to our website, which is www.lonestarlegalaid.org. And at the top, we have information about where you affected by recent storms. You can check out our resources for Texas storm recovery. And this is a website, this is a page that will pop up. So if you're looking for assistance regarding FEMA and SBA, the SBA, just so you know, federal assistance is now available to individuals in Harris, Liberty, Montgomery, Polk, San Jacinto, Trinity, and Walker counties. This aid can help with temporary housing, home repairs, low-cost loan for uninsured property losses, and other programs designed to support recovery efforts. If you have sustained losses, you can apply for assistance through the following means. And just to note, your application deadline is July 16th. You can go online to www.disasterassistance.gov. You can call FEMA at 1-800-621-FEMA or 1-800-621-3362. You can also download the FEMA app, which is something new I just learned about. And relay service users, you provide FEMA with the number for your relay service. Your SBA is a disaster loan application. So information about that is homeowners, renters, and businesses of all sizes in areas designated as disaster zones may be eligible for Small Business Association disaster loans by visiting lending.sba.gov to get started. And remember, just because it's called Small Business Association doesn't mean you have to have a small business. They do help homeowners and renters as well. As a side note, as of May 23rd, 2024, additional counties were added to include Eastland, Hardin, Jasper, Jones, Lamar, and Waller. Counties may continue to be added. So if you receive SNAP benefits and you lost your food during the power outages, SNAP is replacing benefits. You will have to call 211 and select option 2, or you can download and submit Form H-1855, which is an affidavit of non-receipt or destroyed SNAP benefits via mail or fax. I believe it might be faster to do it via fax, and you can find a fax machine if you don't own one, at your Office Depots or FedEx or UPS offices. Deadlines for residents of Austin, Chambers, Colorado, Harris, Liberty, Montgomery, Polk, San Jacinto, Trinity, Walker, and Waller counties is June 17th. I know it was first 10 days after the date of loss, so the date we lost power, but they've extended it to June 17th. For other counties, apply in person within 10 days of discovering the loss. Replacement WIC benefits are available through May 31st, 2024, which is just next week. So don't wait to apply for your replacement benefits. You can visit texaswic.org or call 1-800-942-3678 and choose option 3 for assistance. 24/7 breastfeeding support is available via 855-550-667. If you have unemployment related to the recent disasters, you can apply online through the Unemployment Benefit Services. by phone by calling TWC at 1-800-939-6631, Monday to Friday, 7 a.m. to 6 p.m. Deadline for applications is July 16, 2024. Please specify that the application is related to severe weather damage. Ooh. So we're going to give a brief update about our Texas Homeowner Assistance Fund that we were advocating all of last year for. As of right now, the Texas Homeowner Assistance Fund program's purpose was to provide financial assistance to qualified Texas homeowners who have fallen behind on their mortgages and related expenses due to the COVID-19 pandemic. Grants would have covered mortgage payments and property taxes, insurance, and homeowner association fees. The application portal opened March 2nd, 2022, and it began closing down the new application portal on October 9th, 2023. Texas HAP has indicated it closed all applications, has closed the program as of April 2nd, 2024. So right now, the Texas Homeowner Assistance Fund is in the final payments of the program, which means it has stopped processing submitted applications and will make final payments to approved applicants until funding runs out. As far as outstanding payments, the program has committed all assistance and will make final payments over the next several weeks. If you have not received a notice that your application was approved, we might want to start looking for other avenues to concur with our mortgages and whatnot. The call center for Texas Homeowner Assistance will only be able to help approved applicants with questions related to outstanding payments. The call center staff will no longer respond to calls about eligibility or unfunded applications. Applications that were not approved, or if your application was in review and you did not receive notice of approval, this means you will not receive assistance from the program. You should receive communication from the program with the final notice. The program is no longer accepting or processing appeals as there's no more funding available. And so we'll jump right into Lauren's part of this presentation.
Thank you so much, Sam. I appreciate it. Thank you for that great information, information about our current disaster as well. And I see Nia also put in the chat a link to the form to apply for disaster homestead exemptions as well, which is a new option. So now we're going to move into mortgage foreclosures generally. I'm going to talk the bulk about mortgage foreclosures. Towards the end, Sam is going to pick up on contracts for deed, which is a special type of mortgage, and then we'll be available for questions afterwards.
Hold on.
And Sam is being our tech expert and doing the slides. So appreciate your putting up with my less technical skills here. So, okay, so just as the initial introduction, what are mortgages and what types are there? So when someone says the word mortgage, you typically think you make a monthly payment and you pay off a house. And so that's kind of generally true. That's a traditional forward or regular mortgage. There is a product called a reverse mortgage. Those are for specific elder individuals who qualify, where you're paying monthly property tax, you're paying your property taxes, your insurance, HOA, but you're not actually making a mortgage payment. But at the end, the mortgage company will either foreclose on your home or your heirs will have to pay out that mortgage, but you don't have to pay the mortgage during your lifetime. There is something called a deferred balance or a partial claim lien. So there are times when people have a primary mortgage and then they have a second mortgage. They maybe went through a loan modification or something, and a portion of their original balance was created as a second mortgage or a second lien, and they may have that on their home. Sometimes they may or may not even realize that or understand thoroughly what happened during the modification process. So we do see those come up, and that's something that we'll discuss briefly in the loss mitigation section, but those can be something that is still a lien on your home. There are home equity loans and home equity lines of credit. times where you basically borrow against the value of your home and either get a lump sum or get a line of credit to draw from. But those things, again, are liens on your home. And then there's seller financed contracts, which again, Sam will talk about. And they're also called executory contracts, things where you're perhaps buying from a private individual and they've agreed to give you a deed at the end. They can be very risky. We're going to tell you about some options to make yourself more secure if you have an executory contract.
Hold on. I don't know what's, okay, hold on. Okay, there you go.
Okay, thank you. So all those different types of mortgages, whether it's the forward mortgage, reverse, second mortgage, deed of home equity loan, what have you, they all place what's called a lien on the borrower's home. And a lien is basically just an obligation to pay a debt. And it can be enforced, that obligation, by foreclosing on or selling the home if the borrower doesn't pay the terms of the contract that created the lien. So here's the meaning the mortgage. So you sign your mortgage paperwork, that creates a lien or an obligation to pay off that mortgage. And if you don't follow the terms of that contract, like paying a certain amount every month, then they can foreclose by selling the home to get the money back for what you contracted or agreed to. Sometimes the home sells for less than market value, so you can result in a loss of equity if the mortgage is foreclosed on. So if you could have sold it for a certain dollar amount on the open market, but then it gets foreclosed on, people are usually buying foreclosures at the lowest amount that they can afford or that they can sell for. So you might lose some equity in the home. So these are reasons to try and avoid that foreclosure. Okay, so who are the main players in the foreclosure or the mortgage landscape? There are two main players. The first is an entity that you might hear called the owner or the investor or the insurer. You might hear me use those terms interchangeably, but basically that's the entity that finances or mortgages the loan. So if you have a $100,000 mortgage on your home, what bank or investor or owner is that money owed to? They determine the rules that the servicer, which is the second entity we're going to talk about, the entity that you're talking to, usually your mortgage company, they're going to determine all the rules that govern your mortgage and what your mortgage company can do if you get behind and want to do loss mitigation or want to do something to help get caught up again and prevent that foreclosure. So some of the owners or investors are federally related entities, and they have very clear regulated rules for what can be done to help people who are trying to avoid foreclosure. Some of those federal entities are, you may hear Fannie Mae, Freddie Mac, or Ginnie Mae. You may hear government-sponsored enterprise, or GSE. That's one group of these federally related entities. Another one is the Federal Housing Administration, which is FHA. That's a Department of HUD, Housing and Urban Development. That's another government entity. The Veterans Administration, or the VA, and then Rural Housing Services, which is part of the USDA. U.S. Department of Agriculture. So these are all government entities that actually have a role to play within the mortgage market. And then there are private entities like a bank, a trust, that you may just own your mortgage. There's no government involvement. It's just all on the private market. It's important to know who your investor is, especially once you get to the point where you might be facing foreclosure and want to fix that problem, because the investor, again, is the one that sets the rules for what can be done to fix that problem. Here's just an illustration, courtesy of the Joint Center for Housing Studies at Harvard and the National Consumer Law Center. As you can see here, about 65% of loans as of the date, and this was a few years ago, so it may even be more now, I've heard, are these government-backed entities. So they have a big role to play. The next one is the loan servicer. So this is the agent of that owner investor that owns the loan. So that's what you kind of think of as your mortgage company, whose name is on your mortgage statement. It could be a bank, but it could be a loan servicer. There's a lot of different names and acronyms. It's who do you call when you have to make a mortgage payment, or whose name is branded on the website when you go pay online. That's the servicer. And they're the ones who interact with you directly. And they're the ones that you work with when you're trying to clear up any problems you have to get caught up on your mortgage and prevent foreclosure. They're also the ones who send you the notices if you're at risk of foreclosure. So that's the entity that you work with. So here are some notes. You don't get to pick your investor or your servicer. So they can be sold from one to another. The investor just chooses for whatever purpose that it wants to go on the market and sell to someone else, and it can do that. The investor is the one that picks the loan servicer, and you don't get a choice about that either. You should just get a letter in the mail saying, Entity A is no longer your servicer. Effective X date, start mailing your payments to Entity B. It just happens. So just be aware that that may happen from time to time. It doesn't mean you're getting a different mortgage, but you are having different players involved. Occasionally, they're the same entity, but oftentimes they're different. A different entity owns the loan and then hires, so to speak, or engages an agent or a servicer to work with you. If you have a non-traditional mortgage, like a seller finance mortgage, executory contract, again, a contract where you've written privately agreed with a person to buy a house from them, you're not going to have a separate servicer. It's generally just going to be you're interacting with that person. You may, but generally speaking, you're interacting with that private seller. So this is a presentation about foreclosures. So what we're trying to do is understand the situations when you're facing foreclosure. So if things are going well and you're making your monthly payments and no disasters happen, no understandable life events happen, you make your payments all the way through, and then at the end you get a release of the mortgage, a release of the lien, and everything is done and you own your home free and clear. But if you have a problem, it's called a default. That's generally the term that's used, and the borrower must default before a lender may foreclose. So basically, a default happens when a borrower doesn't keep up with terms of the mortgage. Common defaults are things like failure to pay a monthly mortgage payment, which is the most common thing you might think of. But we also see issues with not paying property taxes, not keeping property insurance, having maintenance issue with the house. Those are all terms of the deed of trust or the contract you signed when you took out a mortgage loan. The borrower may be able to get back in good standing or cure or fix this default through a process that's called loss mitigation. That's the industry term for getting caught back up and back in good standing. So again, what are some reasons why borrowers default? So this is kind of showing that life happens, basically. Some mortgages are high cost. People got a mortgage that sounded good at the beginning, but it had a variable interest rate, or interest rates went up. We've seen property insurance costs go up very high, and all of these things can result in a mortgage that increase over time. People have, they lose jobs, they go through divorces, someone passes away and their Social Security goes down, for a spouse couple, say, for example. So people have loss of income. They have increased expenses. They face medical issues from an injury or an illness, and they're limited on how much they can work, or they have those extra expenses. And sometimes with reverse mortgages, we see a misunderstanding with who pays property taxes and homeowners insurance. The borrower still pays those privately on their own, whereas with a traditional mortgage, you kind of pay it as escrow through your mortgage. And so there gets to be confusions about that. Someone doesn't pay the taxes thinking the mortgage is paying them, and then they get behind. So these are all very reasonable, understandable life events that cause people to get behind on their mortgages. So now that we have an idea of who's involved in the mortgage landscape, we'll talk just briefly about mortgage foreclosure in Texas generally. So as a general primary rule, Texas is what's called a non-judicial foreclosure state. So judicial, you think of the term judge. So non-judicial or non-judge, basically no judges involved. In many cases, under most mortgages, a house can be foreclosed without a lawsuit. Foreclosures are the first Tuesday of every month. Now, there is a new rule that if Tuesday is January 1st or the 4th of July, it'll happen on Wednesday, but otherwise it's the first Tuesday of every month. Under federal law, a loan servicer cannot send the first foreclosure notice or file foreclosure lawsuit until at least 120 days have gone by. So you think, wow, that's a lot of time. That's 120 days, that's 4 months. Key here, though, is going to be nonetheless when things start rolling pretty quickly after that. So as soon as you encounter an issue, as soon as you realize you're getting behind, contact your mortgage servicer. You've got a lot more time and flexibility before you start hitting that really critical deadline. Because once you have, all the loan servicer must do is send you a 20-day notice. You've got 20 days to fix this huge issue that you've had. And then if you're not able to fix it, the loan servicer is allowed to do what's called accelerate the loan or make the whole thing due. So for example, if your loan was $100,000, you got behind $2,000 or $3,000 and they give you 20 days to fix it and you don't, now the whole 100,000 can become due. They can accelerate it. And so they don't even have to put the property, do a lawsuit generally. For the most part, they just have to set the home for sale. They just have to send a 21-day notice. If your home is foreclosed, you can't be removed from the home if the buyer evicts you without a lawsuit, though. So that is your one protection. Once the foreclosure has happened, they do have to have a lawsuit to remove you. Now, a judicial foreclosure does occasionally occur, especially for property taxes and HOA situations, but there are certain terms of mortgages that would require a lawsuit. Sometimes the lender files the lawsuit if there's heirs. So if you have successor issues, which we're going to talk about later, where the primary borrower passes away and there's heirs, sometimes they will foreclose without a lawsuit and just do the usual process. Sometimes they'll choose to clear title first and do a lawsuit. They don't have to. With reverse mortgages, if the borrower passes away, they can just do the non-judicial foreclosure, but if the borrower has a different type of default, like tax or interest insurance, they do have to do a lawsuit. So there are these certain protections. However, in Texas, there's even an expedited type of special lawsuit just for foreclosures. They just send you a notice that there's a lawsuit. You have 38 days to respond, and if you don't, it proceeds forward, and they can get a pretty quick even court order to be able to foreclose. Again, after the lawsuit or after that 20-day notice that from the previous, the non-judicial, all they have to do is send a 21-day notice. So it's a second step is they send a 21-day notice before the scheduled sale. So that's it. That's 3 weeks, and you don't even have the notice probably hit your mailbox for the first week. So, and they don't even have to prove that you received the letter. That's true for both judicial and non-judicial lawsuits, non-judicial foreclosure. So it is a very quick process in Texas. So the non-judicial, again, occurs when the terms of the mortgage allow the lender to foreclose without a lawsuit. I think I blurred the 2 slides, but I'll just continue here. If a default isn't cured after that 20-day notice, again, they just send the 21-day notice like the prior slide said. And again, with a reverse mortgage, generally this non-judicial foreclosure occurs after the last borrower dies. So one other comment we wanted to mention right at this juncture is to avoid foreclosure scams. So at the time that you're facing foreclosure, really any kind, you're going to start getting all sorts of notices. It becomes public, you're going to get notices from your mortgage company saying that you're behind. Then you're going to get a notice saying you have 20 days to fix the problem, then you're going to get a 21-day notice of sale. If there's a lawsuit filed, that becomes public record. Then you get a notice of, that there's a court date, that's public record. And so scammers can find this information, and they may contact you claiming that they want to stop the foreclosure. They often want fees paid up front, or they may even say, hey, give me title to your property, and then I'll stop the foreclosure and we'll fix it later. These are highly risky. These are usually scams. Don't let yourself be pressured. Contact one of our community partners like Lone Star or any of the other legal aids. Talk to a trusted friend or relative. Have somebody look over these documents you're receiving. Don't get pressured, because we want to make sure that there are options if you're facing foreclosure, and anyone who's offering you something too good to be true may not be trustworthy. The Federal Trade Commission has an article with all sorts of details, consumer.ftc.gov/articles/mortgage-relief-scams. Reading it for anyone who might not be viewing. But the Federal Trade Commission has an article on scams, and a HUD housing counselor. HUD has certified housing counselors. We have a flyer towards the end. Those individuals could help you identify if what your notice is actually a scam. Now we'll talk about loss mitigation, which again is the way that you work with your loan servicer to get back caught up with your mortgage so that you prevent foreclosure. So again, loss mitigation is the process of working with the loan servicer to avoid the foreclosure. There are home retention types of loss mitigation, and those generally include something like paying back an outstanding balance, renegotiating the terms of the original loan, or some combination of different solutions, adjusting interest rates, adjusting how long the term of the loan is, and so forth, to try to get you caught up and able to make your payments moving forward. The one thing that you do want to know for sure is you have the option to apply. You should always have an option to apply. Sometimes you can't quite qualify. And if that happens, there are what's called graceful exit loss mitigation options. Those are things like selling the home or something to prevent you from going through the foreclosure and hopefully at least keeping as much equity as possible. So general types of loss mitigation, that's going to vary. What precisely is offered and how it's done is going to depend on the type of loan. Like I said, forward, reverse, home equity, the investor, is it a government entity or a private one, and varies borrower eligibility. How much is your income? How much is are your assets, and so forth. But the home retention options generally may include one or more of the following. So reinstatement is generally, I got behind X amount, but then I got a job, I won the lottery, whatever. I can pay everything off all at once, and get back to just square one, start paying the same amount. They just can take what you owe and reinstate where you were. A forbearance is where they would allow you to have a grace period when you're permitted to not have to make your payments, and they're not going to count it as the clock ticking towards foreclosure. But one thing to be cautious about is with those forbearances, when they're over, you're going to have to do some kind of loss mitigation. Either you're going to have to pay all of that unpaid portion at once, or you're going to have to modify or do something to clear it up. So a forbearance may say, hey, for the next 3 months, you don't have to make your mortgage payment, but those don't disappear. You're going to either have to pay them all at once, or you're going to have to roll them into some other kind of loss mitigation. A repayment plan could be where you make your typical monthly mortgage payment plus whatever you're behind on, you pay little increments for another year or two. Loan modification could be they change all the terms or some of the terms in the original contract, that original deed of trust, like the interest rate or how long the mortgage is, becomes matured. It was a 30-year mortgage, now it's a 40-year mortgage, those kind of things. Deferred balances or partial claims, we talked about that as that kind of second loan. Sometimes, and for FHA, for example, there's an option where they say, well, you can't afford to pay off what's past due, but you're saying you can pick up where we left off and keep paying, we'll just give you a separate little loan for that past due amount, set it to the end, and then at the end you have to figure out how to either pay that or do a payment plan on it. But they just make a separate little loan, and that's called a deferred balance or a partial claim. Reverse mortgages have other options, or you may see any combination of the two. Just touching briefly on COVID loss mitigation. So there was a period of time where people were getting very long forbearances. There were a period of time when there was a moratorium stopping foreclosures. That has mostly ended. So the moratorium stopping foreclosures has ended. The public health emergency ended May 11, 2023. So we're at just over a year now. The option to enter new COVID forbearances, which were longer than the typical ones, has expired. Those existing ones, if they had agreed with you to have one, they'll be honored through their expiration, but most of those should have been ending by right now. There were some federally backed mortgages that offered some more easier or streamlined options for doing this loss mitigation process. Some of them, the VA and the FHA, have extended those options, but the VA is ending May 31, FHA through October 30th. We now have some new options. So I do want to highlight some brand new things for a couple of our particular lenders. For VA loans, there's an article here on NPR explaining how the loss mitigation that the VA offered wasn't helping a lot. It was especially tied with the interest rate. As interest rates have gone up, it's been a problem. So now the VA has rolled out a brand new program called the VASP, or VA Service Purchase Program. They basically take the loans in-house and have the ability to do some additional modification. The goal is to help people get a reduction of 20% in their monthly principal and interest payment by lowering the interest rate and extending the maturity date of the loan. The VA is, now this is the interesting key though, so if you have a VA loan, the VA is urging but not requiring loan servicers to not foreclose until May 31st of this year, just next week. But the VA also recognizes it takes a while for the servicers to get on board and train on this new process. So the servicers aren't required until October 1 to offer this. They're encouraged to, but they may not. And so there's that gap from May 31st to October 1st where you may have difficulty accessing this new program, and yet there isn't a VA request for the foreclosure to be stopped. So there are advocates at the national level asking for that to be extended, but that's not come down yet. If you have a VA loan or a VA rider on your loan, ask now, ask your loan servicer. Call the VA Regional Loan Servicing Center at 1-877-827-3702, or go to va.gov and search for housing assistance. The FHA is also rolling out a new program. This is going to be called the Payment Supplement Program. It's a completely different model than, it builds off of an existing model, but it's completely new. It does allow you to use a partial claim, that second loan we talked about. It'll catch you up on your arrears, and for a temporary time, so for 3 years, it can target reducing your monthly mortgage payment. It's not guaranteed to be 25%, but that's the goal. So basically, say you were $5,000 behind, you can use that partial claim to catch you up on the $5,000 and to subsidize your monthly payment for the next 3 years. The issue is you have to be prepared after those 3 years to pick back up and pay the amount that you were paying. So the thought is hopefully it gives time for the economy and the interest rates to catch up, people to get jobs, but it's that reduction in your monthly payment will be temporary. Servicers may start offering this program May 1, so some servicers are offering it, but they're not required to offer it until January 1st of next year. So if you have an FHA loan, this may be available, but it may not yet. but they haven't gotten rid of any of their other programs, so you may still be able to do a different program. So another issue that comes up with loss mitigation, another issue that happens is somebody is a successor in interest. Either an original person takes out a loan and then maybe they pass away and they leave it to their heirs, or maybe they divorce and only one spouse inherits, gets the home after the loan, but after the divorce, but they weren't on the original loan or what have you. Those persons who are now title owners to a house that don't have that has a mortgage on it, they're called successors in interest, and they can't communicate with the loan servicer. If you're were originally on the loan as a spouse, you can, but even then you still have issues with the other spouse being on the mortgage. So, but issues occur when there are successors in interest, and oftentimes they can't communicate with the loan servicer. A successor in interest has to be what's called confirmed. So the loan servicer, you can call them and say, hey, my mother passed away. This was her house. Now I'm living in it now. And the mortgage company still won't tell you all the details other than saying, okay, send us paperwork to prove you are who you say you are. You must have to prove that you have a legal right to the property. So either you're an heir, even if a full probate hasn't been done, there's paperwork that can be done. You have to have an ID, you have to have a death certificate for the person. But you do have to prove that you are someone that the mortgage servicer has the right to speak with. One issue we see here is oftentimes the mortgage servicer asks for probate. They want probate. They want a court document, something with a judge on it, saying that you have a title interest. In Texas, an affidavit of heirship, which is discussed in some of the other wonderful programs through Amos, is a way of getting evidence of who the heirs are just in paper and in writing and signed in front of a notary, and the loan servicers have to accept that as well. And so sometimes that's one place where we come in, is we help get the paperwork and get the mortgage servicer to accept that. So just one thing to be aware of. So what do you do when you're having a trouble getting appointed as a successor in interest, or when you're trying to apply for loss mitigation and the mortgage servicer is saying you don't qualify, or they are saying you need to pay a certain amount that you can't afford? What do you do when you need information and they're not sending it to you? Like, you want to get all the mortgage statements that were previously being sent to the borrower who passed away, and now you don't know what the history of the loan is. You have the right to send what's called a request for information or a notice of error letter. This is a formal letter that's you have the right to do under the law, where you send it to the mortgage company in writing, and they have to investigate. They have to look at it and respond to your request. And that kind of, when you call in, that's informal and that's great and it's important and it's quick, but you don't always get all the information you need. And so this is a way of getting it in writing. You can also tell the mortgage servicer if it made a mistake, like if it says, we're not going to confirm you as a successor in interest because you don't have a lawsuit saying that you're the heir. You can write this notice of error and attach your affidavit of heirship and say, no, this is proof that I'm the heir. Now, the only issue with these letters is that they do, the servicer has a long time to respond. They get 30 days to respond, not counting weekends and holidays, and they can ask for extensions, 15 days. So we often say, start informally, call the mortgage company, tell them what your issues are, and then follow up with this letter. And the letter needs to be sent to a specific address, the address that the mortgage company puts either on your mortgage statement or on the website, called an NOE or RFI address, or QWR, qualified written request. And make sure to put your name, the property name, the loan number on the letter. So next slide. So what do I put in a letter? Well, we have a tool. So rather than giving you an outline of the letter, you can go to our resource library, lonestarlegal.org, lonestarlegal.org. That's the same website where all of our other resources are. You'll see resource library. And if you go to the next slide, thank you. If you click on the foreclosure topic, you'll see the first one is get help if you can't pay your mortgage, A2J, which stands for Access to Justice, self-help, and that will bring you through a worksheet that will help you prepare a letter to your mortgage company. Next, briefly, we're going to talk about home equity loans and HELOCs. So what is home equity? Home equity is the amount of money that your property is worth minus any existing mortgage or other liens. So for example, if your home is worth $100,000 and your mortgage balance that's remaining is $75,000, then you have $25,000 of home equity. If you're able to sell that home for $100,000, you pay off that $75,000 mortgage and you get $25,000 left over. So you do potentially have the right to borrow on that $25,000 equity that's there. One type of loan is called a home equity loan. You're using your home as collateral again, and rather than using it as a purchase money mortgage, saying, I'm taking out a mortgage so that I can buy a home, you're saying, I already own a home, I'm borrowing against what it's worth. It usually will have a fixed interest rate. You'll get a lump sum of cash up front, and then you pay that cash off in monthly installments, just like a regular mortgage. You can use that upfront cash to make home repairs or do what other things you might need to do with that money. It is potentially a situation where you could have two loans. You could have your original mortgage and maybe you've paid on it for 20 years. You don't have a whole lot of it left. Now you have equity, and now you're getting a second loan to tap into that equity. But just like any other mortgage, home equity loans can foreclose. And then there's what's called a HELOC, home equity line of credit. It's a different type of home equity loan. It has a time period in the beginning called a draw period or borrowing period when you can both borrow money and make minimum payments. You take out a little, you pay a little. Maybe you need some more, you take out some more, and so forth. And then after that draw period is done, you can't take out any more money, but you enter a repayment period where the only thing is that you're doing is repaying. You're repaying the amount you already took out. Sometimes you may have to make a balloon payment at the end of the loan term. So since it's variable how much you took out in the beginning, you might find yourself in a position where the loan is over and you owe a really big amount still at the end. And you may have to refinance that payment to be able to fix that, or you're at risk of foreclosure. And these home equity lines of credit can also have adjustable interest rates, and those can become kind of risky because you can wind up owing more than you would have thought when you first took it out with a lower rate. Next, we'll talk about reverse mortgages. So Amos had a wonderful presentation back in February of 2023. Here's a screenshot. I don't know if Ms. Young's been able to speak since, but she's a certified credit HUD housing counselor, and she did an incredible in-depth discussion just on reverse mortgages. So I just wanted to mention that. So reverse mortgage is technically called a home equity conversion mortgage. So we just talked about home equity loans. This is even a more specialized type of home equity loan called a home equity conversion mortgage, or HECM, HECM. And again, it's a special loan, and you have to be 62 years of age or older, and you have to own the home, and you have to live in it as your primary residence. And there's no personal liability on the loan. The security is only the house, so they can't sue you personally to get back the money on the mortgage. They can only use the value of the house, which means they can foreclose. Whereas a regular mortgage, they could foreclose and they could potentially sue you. So you have those two different options. There is no monthly principal and interest payment on your loan. But you have to pay property taxes, HOA fees, and homeowners insurance. So with a typical standard mortgage, you're often paying those property taxes and homeowners insurance through an escrow account. You make one payment to your mortgage company, it's covering your principal and interest that you owe, and it's covering what you owe to your insurance company, and the mortgage servicer is paying the insurance company out of that. It's covering your taxes, and the mortgage company is paying your taxes. That's not what happens in reverse mortgages. You have to keep up with that and pay it on your own. And you have to have equity, and a good amount of equity in the home. So unlike an original purchase money mortgage where you owe most of the value of the home, you have to have a home where not a whole lot is owed on it, or at least you have enough equity to be able to tap into something. And that's true with an equity loan generally. And you also have to maintain certain maintenance standards. So they're going to do inspections and appraisals and make sure the home is in a certain condition before they'll even lend you the home equity loan. So a reverse mortgage balance grows over time. This is a chart from the National Consumer Law Center and the National Center on Law and Elder Rights. With a regular mortgage, it starts out high, and over time you're making payments and it goes down. The reverse mortgage, it starts out relatively low. You've taken out an amount, and they'll actually give you an amount up front or what have you, or you get an amount little by little over time. But then servicing fees get added, interest gets added. You may owe other things. Sometimes there are set-asides for maintenance or taxes and insurance, things that they count at the beginning and they don't give you cash, but it's going to be owed. All these things add up, and by the end of the loan, it actually increases. So again, the loan balance can increase, may even increase to be higher than the value of the house. And if it gets to a certain amount, which is 98% of the claim balance, basically how much these are insured for, if it grows to a very high balance, the investor that owns your loan has the right to assign it to HUD, meaning Housing and Urban Development will now own your loan. And you'll get letters in the mail telling you these things have changed. So just so you know, those things can happen. That loan balance, so just to clarify, you did take out a loan. In the beginning, they gave you some money, or they gave you the right to draw on a balance periodically. And then that balance is due either when you sell the home, like any other mortgage, or when you no longer occupy the home for more than 12 months without permission from the loan servicer. So if you're out for medical reasons or what have you, you only get to be gone for 12 months, or you have to get the mortgage servicer's permission. If the last surviving borrower dies, so once all of the borrowers on the loan have passed away, the loan has to be paid off, which, as we're going to mention several times, that means the heirs either have to pay off the loan or sell the house or what have you. They don't get the ability to take over that loan directly. And of course, the loan becomes due if the borrower defaults. So those 4 instances: you sell, you no longer occupy, the last borrower dies, or you default. And defaults can be things like not paying taxes, not paying insurance. And again, the heirs can't just assume the loan or start taking over the loan, like those successor and interest we talked about previously. Forward mortgage, someone dies, if you can afford to, you can keep paying on the loan and you're okay. With these reverse mortgages, the whole balance has to be paid pretty quickly. You may have to probate or consolidate title as an heir to be able to sell the home or do what's needed to get that paid off. So what are some benefits and risks of the reverse mortgage? So benefits are you can receive a payment as a monthly installment, as a lump sum, or as a line of credit up front, based on the equity in your house. There's no restrictions on how those funds that you get are used. You can just get cash, you can make home repairs, you can pay off debts, you can pay off an existing mortgage. So some people use reverse mortgages to pay off a previous mortgage, or even to go from one reverse mortgage to another, depending on the situation. You can pay off tax liens with them as well. You have the ability then to access funds for an emergency or to supplement financial resources. So if you know your fixed income is going to be less than you would like it to be, and you have a lot of equity in the house, you get to live in the house and tap into that equity during your lifetime to live on. You don't have to make those principal and interest payments. You can live and not have to sell the home. And this works best if you either have no intention of leaving home to the heirs, you know that your heirs or that the rest of your estate will be able to pay off the loan balance when the loan comes due. Those are circumstances where this might work for you. But there are some risks. First risk is that it may sound great, but you couldn't get one. Not all properties and homeowners qualify. Again, you have to be 62 or older. The property condition, the value of the equity, those all have to be the right math before you can qualify. You can't defer your taxes, and this is something that's true of other mortgages as well. You're contractually obligated through your deed of trust to pay your taxes because tax liens can be foreclosed on too. So mortgage companies want to protect their collateral. So you can't defer or put off the taxes. Typically, if you're age 65 or disabled, you could otherwise do that. And Amos has some amazing presentations from the appraisal district and the tax office that talk all about that. Our group also does some presentations on taxes and tax foreclosure, so just so you know. And again, risks. You can be foreclosed on if you don't pay the taxes, don't pay insurance, don't pay homeowner association fees, even though that's something you might not recall. That's important too. Maintain home in good condition or have to leave the home for more than 12 months. Let's see, you can't leave the property to the heirs without them paying it off. There's a whole circumstance with non-borrowing spouses. We're going to have a whole slide on that, so we'll talk about that. It can't be absent for 12 months. The interest rate added to the loan balance, the loan increases over time and can exceed the value of the home. So next slide, please. Okay, so now we'll talk about the defaults and loss mitigation specific to reverse mortgages. So one thing to keep in mind, we're talking about FHA-backed reverse mortgages. So the investor for virtually all reverse mortgages is the FHA, and they have these very special regulated loss mitigation options. Private label or private investor non-FHA mortgages, reverse mortgages do exist, but they're very rare. If someone were to have one of those, they have to talk with their actual loan servicer about what their rights are. But again, today we're covering the FHA mortgages. So you'll have several options to get caught up if you have a reverse mortgage and have gotten behind. When I say gotten behind, if you have not been able to pay your property taxes or your insurance and now owe the mortgage company. So when you don't pay your property taxes or your insurance, the mortgage company actually, to protect their collateral, will pay it for you. And now it becomes something that you owe the mortgage company. So they'll check the tax records each year, see that, oh, you haven't paid your taxes. They'll pay the tax units, and then you'll get a letter in the mail saying you're in default on your mortgage. You owe the mortgage company $2,000 because that's what we had to pay in taxes. So one option is to just repay that amount to the mortgage company. They'll review your income and expenses, and if so, they'll give you up to 60 months to pay the servicer in equal monthly payments. Advocates are trying to get HUD to extend it beyond 60 months, but right now it's up to 60 months. Repayment plans were once only offered, were generally only offered once, like one bite at the apple, but new HUD guidelines are going to allow a second chance. So new guidelines will also allow successive repayment plans and arrears over $5,000. So it used to be that you had to have a very small amount owed and you could only do this once, and now they're loosening those guidelines a little bit. But not everyone will qualify, but there's now even loosening the guidelines more, that if the math doesn't appear on paper like you have enough money for a repayment plan, but you can give them some reasonable expectation of performance, like your Social Security's coming in soon, or your daughter helps you out all the time, or whatever, then they should also give you the chance to at least try the repayment plan. Then there's something called informal delay. It used to be only if there was $2,000, now it can be over $5,000, but the lender can just basically informally allow you to make payments at a rate that works for you. So there's the formalized, structured repayment plan. Monthly, you pay X amount. Here, you sign this contract. Informal delay is more of something they're going to come up with a figure that you can afford, and you're going to agree to pay it, and they just allow that to work out. Reinstatement is something to know about. So once the mortgage is behind, the mortgage company can considers the loan in default, and they can accelerate it after they've given you that 20 days. The deed of trust on a reverse mortgage gives you the right to reinstate the loan. You can only do this at once every 2 years, but you can use these payment options to reinstate the loan or get yourself back in good graces, even if they have said, we've counted the whole loan due and now we're going to foreclose. You can stop that process with a reverse mortgage and get caught up. There is something also called an at-risk extension. Now you have to try these repayment plans first. They have to assess you, determine if you're eligible. You have to at least try. But if you can't qualify, or you can't afford it, you try and you default, then for those who are 80 years old, and the youngest borrower has to be 80. So if you have a borrower who's 78 and the other is 80, you have to wait for that youngest borrower to be 80. If there is a critical medical circumstance, like a terminal illness or physical disability that would be worsened by a foreclosure, then a physician can write a statement to the mortgage company explaining that you would be severely worsened by a foreclosure, and they can basically just extend the time that you have to pay that loan arrears balance. So again, the youngest borrower has to be 80, and you have to have critical medical circumstances. You have to have tried to use a payment plan or not qualified. Then a doctor can send a letter to the mortgage company saying they're going to be exacerbated with their health if you don't give them an extension to pay, and then the mortgage company can't foreclose. It used to be that they had to recertify every year. HUD removed that requirement on April 29th, 2024. So servicers are still getting on board with that. They're still asking people to recertify annually. If it's not difficult, go ahead and do it. But as soon as the dust settles, you shouldn't really have to be recertifying every year. Here's something related to non-borrowing spouses. So when someone takes out a loan, a mortgage loan, you can be obligated on the mortgage by being a borrower, and that's separate from title. So title's who owns it, and sometimes you can have, say, two spouses who are on title and own the property, but say one of them didn't have the best credit or what have you, only one of them might be obligated on the note, might be a borrower on the note because they use that person's credit. Or, for example, prior to 2014, if somebody was under age 62 and the couple wanted a reverse mortgage and somebody was over 62, they would just leave the younger spouse off. Can't do that anymore, but they used to. So once the contract to pay the mortgage came due, because the last borrower passed away, the spouse who was left was facing either paying off the loan or being foreclosed on. So now they have extra protections up front and options for the non-borrowing spouse, if one is there for a reason, to be able to take over the loan and stay in the home if they were married to the original borrower. but prior to 2014, they didn't have that in place. So now there's something called a mortgagee optional election. Spouses must have been married at the time the loan originated or have been in a relationship akin to marriage and married once legally allowed. They must not have remarried, and they must have a legal right to occupy the property. So they don't even have to have title. They might have a life estate or something like that. Now the spouse can then fill out paperwork and apply. This is another time to use one of those notice of error or request for information letters that we talked about to let the loan servicer know, hey, I'm a spouse that's left. You're sending me foreclosure notices. I'm entitled to apply for this program to stay in the home. The non-borrowing spouse, though, will still have to pay taxes and insurance and HOA fees, and they won't be able to draw on the loan. So if they had the type of reverse mortgage where they were still taking out monthly payments or what have you, they won't be able to do that anymore. So this is just a quick reminder. If the mortgage loan was taken out before August 4th, 2014, you need to do this mortgagee optional election process, a bunch of paperwork. Afterwards, there's a special deferral project that's a little easier, and the spouse was identified at the time the loan was originated. Again, this is a chart courtesy of National Center on Law and Elder Rights and National Consumer Law Center. Options for non-spouse heirs. So one type of heir to a borrower who passed is his or her spouse. Another type of heir might be anyone else, so children or what have you. So let's say both borrowers have passed away. There's no surviving spouse. The other heirs, the children or whoever that has been given the house in the will or what have you, get 2 90-day periods after the death of the borrower to do one of the following things. And they also can ask for extensions. We'll talk about that next, but they have initially 6 months to pay off the loan. They could refinance the loan with their own loan. They could pay it off cash. They may have to do some kind of probate or consolidate title because you can't mortgage property without title being clear. They may even be older themselves and want to use a different reverse mortgage that's in their name. That's the most common time we see one HECM buying out another, so to speak, but they may need to clear up by paying. They can transfer the title back to the lender via a deed in lieu of foreclosure. So they sign a deed back to the lender. Again, some probate may need to be done so that they have title. If the loan balance is worth more than the home is worth, they could potentially sell the home for at least 95% of the current appraised value, which would probably result in a short sale, a sale where the loan balance, even though you sold off the whole home, still doesn't cover the entire amount past due. The value will be based on an independent appraisal, not the appraisal district. So you have to have the lender's approval to basically sell it for less than the loan amount and have them count it all as good enough. You can ask, you get those initial 6 months, initial 2 90-day periods, but heirs can ask for extension of up to 2 more 90-day periods, but those aren't guaranteed. You have to show progress towards a resolution. So here's my probate lawsuit, and we filed it 4 months ago, and it's still in the courts or something like that. Another brand new option, mortgage companies, servicers may be able to offer up to $7,500 cash for keys, meaning deed in lieu or something where you give back the property, or up to $5,000 for probate costs to get the title clear. If you're doing, again, a deed in lieu or a short sale, or even before a completed eviction. So maybe the mortgage company has bought the property back after foreclosure, you may at least be able to get some help to relocate instead of going through eviction. The Federal Housing Administration, FHA, has a great flyer that summarizes all this stuff for non-borrowing spouse heirs. So you can go to HUD.gov and look for a flyer on a inherited home equity mortgage. So a few additional comments. what do you do if you want to complain about your mortgage servicer? So, what if you think your mortgage servicer is doing something wrong? What if you've given your mortgage servicer your affidavit of heirship and they're still not considering you an heir and confirming you as successor in interest, or they're saying you don't qualify for loss mitigation or for a loan modification or what have you? You can file a complaint with the Consumer Financial Protection Bureau. The phone number is 1-855-411-8972. You can go to consumerfinance.gov, and click on complaint. They have to actually respond to these complaints. The CFPB will reach out to the servicer. They take that seriously. I've gotten quick responses from these complaints. Also goes into a database that the CFPB maintains so they can see trends over time. So it's good to make these complaints. If they see everyone in the country is complaining about a certain issue, it might get their attention. You can also contact the HUD National Servicing Center, 1-877-622-8525 is the phone number, or you can go to HUD.gov and search for the National Servicing Center. You can complain to them as well that you're having trouble with your loan. What do you do if you don't qualify? So we've talked a lot about different options, but you may not qualify. Basically, the mortgage company may want to know that you have enough to pay back the loan and not find anything that will allow you to modify or what have you. So one option, again, might be refinance the mortgage. Maybe a different mortgage company will work with you. If you qualify, you might be able to file a Chapter 13 bankruptcy. Basically, you have to be able to pay off the mortgage arrears and the current mortgage and all your other bills. So, you know, it depends, but you might qualify for a bankruptcy, and Chapter 13 is what saves the house. Chapter 7 is liquidation and you sell the house. Chapter 13, you could potentially save it, but you do have to pay things off. You could sell the property on the open market. That at least allows you to capture the equity. So if it's in foreclosure, it's going to sell it bottom dollar, right? But if you sell it on the open market, you should hopefully get the full value of the property back. With the loan servicer's permission, you could sell it for less than owed, which we talked about in the previous slide, a short sale or a deed in lieu. The servicer may offer limited relocation assistance. So not only did they just allow that for reverse mortgages, but other mortgages may choose to do that to help. There could be tax implications. So just find out if you're getting a large amount forgiven by selling. Another protection is if your home is foreclosed, the new buyer must file an eviction lawsuit to remove you. So the new buyer could be a third-party investor that went to the foreclosure sale and bought it, or often it's the mortgage servicer. If nobody bids enough, the investor that owns your loan actually will now have bought back title too through the foreclosure, and then they will be the one trying to evict you. But you do have to have that eviction lawsuit to be able to be removed. HUD housing counselors are amazing. They have specialized training to be able to help people through these issues. You can go to HUD.gov and search for housing counseling. Again, you can apply with Lone Star Legal Aid or any of the other community legal partners here. So those might be options for you. Okay, and now we have Sam taking over to discuss one final special type of mortgage, which is a contract for deed or executory contract. Thank you, Sam.
No problem. What are contracts for deed or or as another name for them is executory contracts? So an executory contract is a long-term agreement to buy property. It's different from traditional owner financing. The seller in an executory contract option, the seller retains title to the property and the buyer does not receive a deed to the property at the time of the sale. The buyer then pays down a down payment followed by monthly or periodic payments over time with the 180 days minimum. So it seems like a traditional mortgage, but instead of a mortgage company, it is person to person. The seller will then transfer the deed to the buyer upon the final payment of the loan. It is also commonly referred to as a contract for deed, a land sale contract, or installment land contract. You might also hear of them as for sale by owners. So who buys property when using an executory contract? You may see buyers who have low credit score, recent bankruptcy, or cannot get a financing from a traditional lender. There are buyers who have little or sporadic employment history, and buyers who have a high personal debt to income ratio. Also buyers who have changed their employment situation, and buyers who can't afford a large down payment, typical mortgage fees and closing costs, and/or who have insufficient collateral. What is important about these contracts? These contracts are potentially predatory. The Texas law has now added strict consumer protection laws, and Texas legislator has found that executory contracts for the sale of residential property have long been disfavored because they encumber title without transferring title. They cannot be sold in the real estate market, and they cannot be used to borrow money to make improvements, and are potentially abusive transactions under which legal title to homes or property may be withheld until many years after the buyer has built a home and made other expensive improvements. Under Texas Property Code, Chapter 5, Subchapter D, this statute applies to any transaction involving an executory contract for the conveyance of real property to be used as residence by the purchaser or the purchaser's family member, where the contract is to be completed more than 180 days from execution. This includes residential lease agreements with a purchase option to buy, but some consumer protections do not apply. This does not cover contracts with governmental entities or between family members. It's a parcel of land measuring 1 acre or less is assumed to be residential. It provides statutory obligations, remedies, and statutory damages for violations. There are some risks for buyers who use executory contracts, whereas traditionally a buyer does not become the legal owner until all payments are completed. So again, you sign the contract, you put your down payment, you don't receive your deed until all of your payments have been made. A traditional mortgage, you receive your deed then when you sign. There are now options for the buyer to get title during the term of the contract, but the buyer has to know about and exercise their rights. The buyer has limited control over the property while under contract, especially if the contract is not recorded. And we'll talk a little bit more about recording the contracts later. The buyer can record the contract on their own if it is notarized. If it is not notarized, you can use a signed notarized affidavit of facts, add it to the contracts, and record within the county. And we'll discuss a little bit more about what that affidavit has to state in a few minutes. There's also a risk to losing the property and all money paid toward the property if you default. The seller can cancel the contract and retake the property, keep all payments you made, and benefit from any improvements that you have made towards the home. The seller may not have clear title even though they are supposed to. So traditionally, when you go and you get a mortgage from a finance company, they do a title search and make sure that the mortgage company owns the home to sell to you and nobody else does. In a executory contract situation, sometimes the seller may not own the property and is just selling the house as their own, which can lead to even more legal problems in the future. The seller may also continue to encumber the property with mortgages and liens, even though they aren't supposed to. So think, hey, they're selling you this home and you're paying the seller, but then the seller decides they want to take out a second mortgage on the home and then not tell you about it. These are some of the risks that you can can come across during an executory contract sale. The seller may also try to evict the buyer rather than foreclose, which is a quicker process rather than the longer traditional foreclosure process. And if you don't know your rights, you may fall for that, but they do have to go through the foreclosure process as well. So some key buyer protections for an executory contract is you have a right to convert your contract. The seller is required to record the contract within the county deeds records, but they often do not. You have a right an absolute right to convert the contract to recorded legal title at any time without penalty or charges, according to Texas Property Code 5.081. The seller has no choice in the matter so long as the buyer tenders the balance owed under the contract. This is true whether or not the executory contract was recorded. You have a right to request balance and trustee. The buyer can demand to know the amount owed under the contract and, if applicable, the name, address, and of the seller's desired foreclosure trustee. If the seller fails to respond within 10 days, the buyer can determine the amount owed and, if applicable, select a trustee. The seller has 20 days to contest the amount determined and must send a written objection to the buyer. The seller's objection must be based on written records, maintained and regularly updated by the seller under Texas Property Code 5.083. The buyer may offset amounts it owes the seller against amounts for which the seller is liable as a result of its violations, and the buyer does not need to sue the seller in order to offset. The buyer also has a right to cancel the contract for any reason within 14 days of the date of the contract by giving written statutory notice. So we come across this a lot, as we mentioned, recording your contract for deed or your executory contract. If the seller does not, you do have the absolute right to do it. So how does one go about doing this? If they don't record the contract in the county deeds record, you can record it yourself. The contract must be a notarized original copy, a certified copy, or be attached to an affidavit. You can file it in person at the county clerk's office or by mail. If you don't have the original notarized contract or a certified copy, you can take a copy of the contract and still record it, but you will need to include a notarized affidavit concerning executory contract for the conveyance of real property with the original executory contract. The notarized affidavit must include your name, state that the attached affidavit is a true and correct copy, and you're recording it under Chapter 12 of the Texas Property Code. It must also include that this is an executory contract for the conveyance of real property under Chapter 5 of the Texas Property Code. It must contain the property address, a legal description of the property, names of who signed it, such as the buyer and the seller, and the date that it was signed. It must also include that the contract was not already recorded, but that you're recording it now in accordance with Chapter 5 of the Texas Property Code. And if the property is in your home, is your homestead, state that as well. So key things to take away: you have a right to record your own contract in the county deeds records if the seller does not. Make sure you have a clear title to the home that you're buying. Oh, and I had another list and it just slipped my mind, but it'll come back to me. Also, you do have a right, well, they do have to legally provide you a copy of the contract in the language that you speak. So if you speak Spanish, the contract, they must also provide a copy in Spanish for you. They also must provide you with an accounting statement at the beginning of every year, including any payments that were made to you and the balance, deducting it from the balance owed originally and with your new balance that is currently owed after all your payments. So what happens if you default on your executory contract loan? First, the seller must give you a written notice of default by certified or registered mail with certain statutory language and give you 30 or 60 days to bring your loan current. If you have paid less than 40% of the purchase price or less than the equivalent of 48 payments, a 30-day cure period is required. If the contract is not recorded, then the seller can rescind the contract and evict after 30 days. So this is important why you want to make sure it is recorded either by yourself or the seller. If the buyer has paid 40% or more of the purchase price or the equivalent of 48 payments, or has a recorded contract, regardless of the amount paid, a 60-day cure period is required. If you fail to cure, then the seller may sell the buyer's interest in the property at a foreclosure sale. Following foreclosure, the purchaser at foreclosure may file to evict the buyer. And that is it. I guess we'll move on to our questions portion of today. So if anybody has any questions, we're here. List them in the chat.
I'm extremely surprised that you guys must have done a really thorough job because there are no questions in the chat so far. Because that was a lot, but it seemed like that was a lot more information than normal. I mean, why does that seem like there
We
was more stuff that you threw in there?
Well,
because our disaster.
we had a disaster. We made it more clear what to do to record. We hope, we hope to improve every time. So I'm glad you felt there was more information.
It was because usually we always try to we make light of the fact that we listen to these every time, but there's always some new information that kind of comes up, or new processes or new changes or new laws
Mhm,
or new whatever that comes up, which is why we invite people to keep coming back every single month
mhm,
because you never know what's going to happen, especially with the change in disasters as they happen. Like HCAD submitted that information about the disaster exemptions. People are protesting their property taxes right now. So you might want to, if you experience any kind of hardship or whatever, you might want to go ahead and take advantage of any kind of disaster exemptions that you can before your tax bill becomes due when they come out, those tax statements come out in October, November of this year. So yeah, that seemed like it was a little bit more information
mhm.
uh than what I can recall from before. But yeah, I don't have any questions in the chat. I don't um one question that was emailed to me, I know that you actually talked about it, but what's the biggest difference between a home equity loan and the reverse mortgage loan?
Excellent question. Well, the first thing is that to get a reverse mortgage, you have to be at least 62 or older. So that's not an option if you're not. The next thing is that with a reverse mortgage, you're making monthly payments. Sorry, you're not making monthly payments with a reverse mortgage, whereas with a home equity loan, you're still making monthly payments on what you've borrowed.
Okay. Yeah, I don't see any questions on Facebook there either. Uh, yeah, there are no questions in the
Okay.
chat here. So, you guys actually covered, like I said, a lot of information that it didn't bring up any other questions that I had. Typically, I usually have like something else that kind of pops up on my brain that I don't
Yeah.
about previously. So,
Okay, well, that's good. Well, yeah, there was new stuff about from the VA and the FHA. I mean, that training was literally like a week or two ago, like brand new stuff. So, like you said, for this presentation and all of them, there's new things that come up to keep tuning in for. Let's see.
there's a question with regards to the reverse mortgage. Can you go back to a regular mortgage at the end point?
Maybe when the owner yes. Okay, so you mean refinance the balance. Yes, absolutely. So if the owner passes away and there's a reverse mortgage of, and the principal and interest is 75,000 and you can qualify for your own mortgage of 75,000, that's a traditional forward mortgage, you can use that to pay off the home equity loan. You could potentially get another home equity loan if there's enough equity in the house, and if the heir is old enough. So yes, you can use one type of loan to pay off the other.
Absolutely. And if nothing else, if the intent is to actually keep the property, refinance if you can, or get that paid off, because you do not want to have a house go into foreclosure for a reverse mortgage that's not even a third or half or a tenth of the value of what the actual property is. I've seen so many people that have lost their homes over a period of years that have like a $10,000-$20,000 reverse mortgage, and property is way more valuable than that, and then they lose it. And then you get those issues that come up when you got heirs that nobody wants to, they want to argue over, who's going to pay it, who's going to do this, who's going to do that, and then everybody ends up losing in the end. So, and then talk to your relatives too, because sometimes you get mothers, grandmothers, grandparents, or whomever that will enter into a reverse mortgage and don't tell anybody. They don't like people in their business when they get to a certain age. They don't want to tell you when they get behind on their bills, or Social Security just isn't enough to maintain or cover, their monthly expenses, and they end up getting a reverse mortgage. So definitely have the conversations about whatever. Every once in a while, if you have to be a little nosy, look through those bills and see, what's owed and what's due, just so that you're not kind of caught off guard, in at the end. And
Especially
you
if you
run you
plan
run
on
that risk,
and especially if you plan on inheriting that property. And then you're like,
especially.
what do you mean my mom owes 40,000 to this reverse mortgage loan?
Exactly.
Yeah. And
Exactly.
And like Nia said, if you can refinance or do whatever, because if a property goes into foreclosure, you often lose equity. The buyer only has to pay off whatever was owed, and the mortgage company can't keep the extra, so they don't care if it sells for extra, right? So if you can refinance that and not let it be foreclosed, or absolutely worst case, at least sell it yourself for a real market value, you at least keep the extra, if that makes sense.
Amir kind of touches on this a couple of other in some of the other presentations. So if someone's house does end up going into foreclosure, say if they only owe, 30, $40,000, and the house is sold for much more than what the actual foreclosure amount is, what happens to the difference of the money that's sold at auction?
Excellent. So that's the excess proceeds, and the heir or the owner is entitled to those funds. So whomever was the title owner before and the borrower before would be entitled to those funds. So if there's a judicial foreclosure or lawsuit, those excess should be in the registry of the court, and there's an application that you file to get that. But you do have to go before a judge. A lot of the judges have templates and things even. If not, it would be in the trust account, probably of the either the company, the servicer that's the sold, like their attorney. It would be in somebody's trust account, so you could contact them. It could lead to a probate issue, because if the heirs don't have all the probating done for who the name of the excess proceeds is going to, that could be something that needs to be resolved. But you are correct. If there's extra, if it sells for more than is owed, then the mortgage company does not get to keep the proceeds.
But there's a process. You have to
But there
apply
is a
for it. Yeah,
process.
they don't
They
just
don't,
send you it. They don't just send you
you
a
just,
check and just think,
I was gonna
oh,
say,
you go ahead and sell it. I'll get the other $60,000, and nah, it doesn't work that way. Because
no, you don't,
otherwise, yeah,
no check in the mail. You've got to do a little something.
yeah, you
Yeah.
definitely got to do it, and it's definitely worth it. Do not let your parents or relatives' homes just kind of go
Mhm.
because of that. Um, yeah, I believe that was it. All right. Well, thank you all very much for coming back and tuning in with us this afternoon. Thank you very much, Lauren and Samantha. We definitely appreciate you guys. I mean, again, that was a lot of information that was covered. I know you guys are probably a little parched by now. Go ahead and try to grab some lunch or what have you if you can. We really, really appreciate you guys volunteering and participating and provide this information to the community every month. A lot of people do question and they ask, why do we do these every month or whatever? Well, this is why, because more people need to get as much of this information as they possibly can, so that they can possibly share it with somebody else who is also facing foreclosure or has questions, or they listen to the other people that really don't know what they're talking about. So there's a lot of misinformation that's out there, and we want to try to put as much accurate information into the hands of the public so that they can make informed decisions, make wise choices, based on good information that they received. And you guys provide us with a lot of good information. So thank y'all very much. Again, if there are any presentations that we don't currently offer that you all may be interested in or need more information about, please feel free to reach out to Rachel or myself. And we will do our best to try to get it incorporated into our schedule for a future workshop. I will be sending out the link of this recording for everyone to go back to watch again, or again to share. We do ask that you pay it forward. And then you can also watch some of the other previous presentations that we've had, uh, uh, previous presentations that we've had as part of the A Month of Service collaboration. And that link for that YouTube channel will be included on that email as well. So With that being said, thank y'all very much. You all have a wonderful, awesome remainder of your day. Enjoy the Memorial Weekend. Stay safe, take care of yourselves, and we will see you all next time.
Okay. Thank you so much for having us. We really
Thank
appreciate
you.
it. Have a
Thank
great
you.
weekend.
Bye-bye.
Bye-bye.
Bye-bye.